Most people think you need real analysis and measure theory to break into quant trading. That's wrong for most roles. Gives you a layered roadmap of the math you actually need, and what you can safely skip. Quant math is not a single mountain you climb from bottom to top. It's a toolbox with 3 layers. The core layer, calculus, linear algebra, and probability, is non-negotiable. The advanced layer, time series, optimization, and basic stochastic processes, is essential for strategy and risk. The specialized layer, stochastic calculus, measure theory, and numerical methods, is only needed for options pricing, market making, or academic research. Most equity factor and CTA roles never touch the third layer. Calculus is the first tool, but you don't need to master every theorem. The key is to understand gradients, partial derivatives, and optimization. You'll use the chain rule for backpropagation in machine learning, and you'll see Lagrange multipliers in constrained optimization. The real test is whether you can find a maximum of a simple function and know that a zero derivative isn't always a maximum. That's enough for most quant work. Linear algebra is the most important math for quant. Every return matrix, covariance matrix, and factor model is built on it. You need to be comfortable with matrix multiplication, eigenvalues, and singular value decomposition. When you see the covariance matrix as x transpose x over n, you should recognize that its eigenvectors are the principal components. If you can hand compute a 3 by 3 eigenvalue problem, you're in good shape. Probability and statistics are the mother tongue of quantitative finance. Everything from sharp ratios to p-values to Bayesian updating lives here. You need to understand distributions, expectations, and conditional expectations. You also need the law of large numbers and the central limit theorem, because they justify why sample averages work. And you must know hypothesis testing, t-tests, ks tests, and white noise tests, because they help you avoid false discoveries. One identity you'll see everywhere is the sample covariance matrix. If X is your matrix of returns, with each column a different asset, then the covariance matrix is X transpose times X, divided by N, the number of observations. This formula is the basis for PCA and factor models. To validate it, you can compute a simple 2-asset case by hand and check that the diagonal entries match the sample variances. Once you have the core, you move to the advanced layer. Stochastic processes give you the language for price dynamics, Brownian motion, geometric Brownian motion, and Poisson jumps. You don't need to master martingale measures, but you should know what each term in the geometric Brownian motion equation means. Time series analysis is even more practical. ARIMA, GRCH, cointegration, and stationarity tests are used daily for forecasting and risk. The key skill is spotting spurious regressions. The standard model for asset prices is geometric Brownian motion. The change in the price S is equal to the drift term, mu times S times dt, plus the volatility term, sigma times S times dw. Here, mu is the expected return, sigma is the volatility, and dw is a Wiener process, which is just a fancy way to say random noise. This equation is the foundation for options pricing, but for most strategy work you only need the intuition, not the derivation. Optimization is the bridge from math to decisions. You need convex optimization, gradient descent, and regularization. Mean-Variance Optimization is the classic example, but it's sensitive to input errors, that's why CVR optimization is often more robust. Machine learning is really just optimization of a loss function. You should understand linear regression, trees, and neural networks from that perspective. The math here is not deep, but the practical skills matter. The mean-variance optimization problem is to choose portfolio weights W that minimize the portfolio variance, subject to a target return. The objective is W transpose times the covariance matrix times W, and the constraints are that the weights sum to 1 and the expected return equals the target. This is a quadratic programming problem. The catch is that the covariance matrix is estimated with error, so the optimal weights are very sensitive to small changes in inputs. The specialized layer is for options pricing, market making, and academic research. Stochastic calculus, including Ito's lemma and Gersonov's theorem, is essential if you're pricing exotic derivatives. Measure theory gives you the rigorous foundation for martingales and risk-neutral measures. Numerical methods, Monte Carlo, PDE solvers, and FFT, are used to price complex instruments. Information theory, like mutual information and KL divergence, helps with feature selection in machine learning. But for most equity factor and CTA roles, you can skip these. Many people get stuck not because of math, but because they can't translate math into code. You need to be fluent in Python, NumPy, and Pandas for vectorized operations. You also need numerical stability, things like log_sum_exp to avoid underflow, and handling collinearity in regressions. And you need to judge statistical significance properly, or you'll fall into overfitting. The math and the coding must be learned together, not in sequence. Here's a time-saving sequence. First, go through calculus quickly, you don't need to be an expert. Then spend real time on linear algebra and probability and statistics, because they're the foundation. Next, learn basic stochastic processes and time series, ARIMA, JRCH, and co-integration. After that, study optimization and machine learning, focusing on loss functions and gradient descent. Only if you're heading into options or high-frequency trading should you add stochastic calculus and numerical methods. And measure theory? Only when you hit a paper you can't understand. So here's the takeaway. For stock factor investing, CTA, and backtesting, you need linear algebra, probability and statistics, time series, and optimization basics. That's a clear, bounded set. For options pricing, market making, or academic quant, you need the full toolkit, including stochastic calculus and measure theory. The myth that you must master real analysis first is just wrong for most roles. Choose your layer, learn the math that matters, and build your edge. The quant math roadmap isn't a one-size-fits-all path. It's a decision tree based on your target role. Start with the core, build your coding skills in parallel, and only go deeper when the job demands it. Thanks for watching. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.